Hey, Colorado Springs. This is Jenny Bayless, and I am here to present the Spring 2023 Southern Colorado Real Estate Investing Guide. So, what this is I just put together, a small presentation to kind of talk about how to invest in this market and just what is kind of changing, some of the things that we're seeing changing in regards to what our clients are doing, lending environment, because there's a lot of lending changes coming out as well, not just interest rate, it extends beyond that. And then also, I wanted to take a step back, and because we get a lot of questions about real estate investing terminology and concepts. And I wanted to actually take a step back and kind of go over that before we dive into, the details of Colorado Springs and Pueblo specifics. So um, I wanted to separate this presentation into kind of three bite-sized parts because it can be a little bit overwhelming. So the first part, which is today's part, is just real estate investment concepts refresher. We're going to go over that and just kind of refresh our knowledge as to what certain terms and everything means. The second one is going to be on financing methods, again, going over different types of loans that investors can utilize and some of the changing changing rules in the lending market. And we're going to have a lender on to help with that. And then the third is going to be strategies that Envision clients are using and going into some of the specific strategies that very recent closed purchases are using, just to give everybody kind of a sample as to what's going on in the market. So the first one, I want to get into, like I mentioned, concepts. And I think that it's really important to understand real estate investment lingo because we really need to kind of sometimes take a step back and go back to the basics. We were kind of on overdrive the last couple of years, but it's really important that you understand kind of the cost associated with your property that aren't as obvious as, principal, interest. Well, principal is not a cost. Interest, taxes, insurance. There are other costs that you need to be, mindful of. And then also just some other concepts that you might hear us talk about quite a bit. I think that it's always important to just kind of refresh everyone on that. So the first one is the term CapEx, which is short for capital expenditures. And those are costs incurred through property ownership for major repairs and replacements of deteriorated or broken components over time. So a good example of that is the roof, the furnace, windows, if you have air conditioning. We always recommend that investors place a portion of monthly cash flow aside to save up for these events. So, you're not going to have to replace your roof every year. You're not going to have to replace your furnace every year, but when you do, and who knows how long, it could be 2 years, 5 years, 10 years. I don't know. That's going to be a huge expense that comes up. And, I always say Murphy's Law says your roof and your furnace will go out in the same year. You'll have multiple properties that all the furnaces die in the same year. So I think that it's just really important to be mindful of that. Your cash flow is not just your rent minus your mortgage payment and escrow. You're going to have these expenses pop up and you don't know when, but you want to be able to have properly saved for them. So, we recommend you just take a portion of your monthly cash flow and put it in a savings account or, some sort of liquid account that you're able to access for when that happens. Vacancy. So this is really basically just an opportunity cost. So when your property is vacant, no one is paying you rent. So you need to account for that as an expense. So, it's kind of the lack of income, but it's an opportunity expense. So, the estimated yearly cost of the property not being rented, we always just do as a percentage of gross rent. Investors, you need to put a portion of that also in your savings account, same as your CapEx, to save up for these events. So, just generally speaking, if you anticipate that your property will turn over every single year, meaning one tenant leaves, the next tenant comes in, you have to account for turnover costs in addition to turnover time. So, maybe you might need to replace the flooring or repaint it or do little fix ups to get it rent ready for that next tenant to make it look nice for that new tenant to move in. So if you were to assume that happened every single year, and it would take 1 month of between being able to fix it up and getting a qualified tenant in your property, 1 month out of the year is approximately about 8%. So you would just set aside 8% of gross rent as a vacancy placeholder, if that makes sense. And then the next concept I want to talk about is the net operating income, also known as NOI, which is the sum of the property's total revenue minus all the expenses. So, including the expenses that we talked about, if you incurred them, of course. So, vacancy would just be a lower rent revenue, and then CapEx would, that would be an actual expense. And then not including debt service. So once you subtract out your debt service, you're going to get your cash flow calculation. So that's very important to know because, when calculating a different concept, which we'll go into next, it does not use debt service as part of the calculation, which is interesting. I think the reason behind that is to be able to compare apples to apples, since the debt feature on real estate can be so different between people. So, one investor might put 25% down, and at a 7% rate, someone else might be able to put 6% down or 5% down at a 6% rate. That's going to really change your debt profile on that asset. So it's able to kind of compare apples to apples that way. Which then feeds into the concept of cap rate. So cap rate is your net operating income, or your NOI, divided by your purchase price. And so that's the way to determine the rate of return on real estate, assuming that the investor did not leverage. So again, you're able to compare properties apples to apples, or at least more closely, since properties are so unique anyways. But you're able to see, hey, this property is looking like an 8 cap versus this property is looking like a 5 cap. Well, why is that? Is there poor performance involved? Is the purchase price too high? Just kind of understanding it that way, especially if the properties are right next to each other. That's a really good way to compare compare purchases and everything. 1031 exchange. So this is a way to defer the recognition of capital gains. So it's under section 1031 of the tax code. So you can defer your capital gains and related federal income tax liability on the exchange of certain types of property. I am not going to go into the details of how to properly complete a 1031 exchange. Definitely reach out to us. I know Chris had done a mini series on this concept a couple years ago. So it's definitely one that you'll want to check out. But just know that the 1031 exchange is, a type of strategy that you can use to, you typically hear people saying trading up. So, they own an asset for several years. It's gained through, appreciation. And then they want to sell that property and trade up to, say they trade a single family for a fourplex. That way they're able to defer the capital gains from the single family sale, roll it into their fourplex, and so on and so forth. The concept is to just keep doing that infinitely. But again, we won't get into the details on that. And then the last one, or second to last one, is BRRRR, which stands for buy, renovate, rent, refinance, repeat. I think that this is a very, very popular method that investors aim to minimize their cash in a property through a combination of forced depreciation, like through rehab, and then creative financing methods. The main goal of BRRRR is to be able to force enough equity that when you go to refinance it, you're able to have created the minimum amount of equity through your forced depreciation, your rehab, that when you go to refinance it, you're able to leave, the created equity in the property from the requirements of the lender and then pull out your initial cash investment. And then you're able to recycle that property. So it's a way to minimize your down payment. And I know that it's a very, very popular method. I like it. It's just very, very hard to do in this environment because you're juggling. Well, I'm kind of going down a rabbit hole here, but my soapbox is that it's a little bit difficult to do this in this environment because you have to keep in mind that you have to have a good guess as to what your refinance is going to look like, which means the after repair value of that asset that you bought. What is that repair value going to be? Well, in today's market in spring of 2023, values are decreasing a little bit. So you have to account for it that way. Interest rates are going up and down, up and down. I have no idea what they're going to be by the time you're done renovating your property and what they're, when you're ready to refinance it. So it's just, something that you want to keep in mind that a goalpost at the end of your renovation is a little bit foggy, and that makes it very difficult to do this type of strategy. So that was a little bit of a tangent, but just wanted to put that into context as to the market today. And then cash on cash return. This is also something we hear a lot of investors say, I want X cash on cash return. Usually people come and say they want 10% cash on cash return. That isn't really likely in Colorado Springs and Pueblo at this time. So we want to be kind of upfront with people, just to put perspective on the market and what's attainable down here. And there may be other markets that you can check out, probably out of state, that may give you that 10% cash on cash return. But I think that it's important to understand why do you want that 10% cash on cash return? So what is that? So basically how that return is calculated is it's the ratio of pre-tax annual cash flow divided by the total amount you invested, which typically consists of your down payment, your closing costs, and your rent ready costs. So people want to get a 10% return on those components. But I personally, when I first started investing, I will admit I was a 10% cash on cash return person as well. And maybe at that time that was more realistic. Just because I started investing in 2016 or so. But as I've evolved my strategy a little bit, I don't focus on that at all, and that's just because that's what they say, the powers that be say that you should get. So I definitely want to go into why cash on cash return should not be the only metric that you focus on as well. So those are some of the lingo that I think all real estate investors should be cognizant of, and be able to really understand the concepts behind. So going into the last point that I made on cash return, there are 4 returns in real estate investing. So real estate investing is very much unlike other investments because it actually has 4 ways to earn a return, or 4 components of your total return is another way to think of it. So the first being appreciation, and appreciation. Oh, I'll actually go into the details of each of these in the next slide. So let me just kind of go through the top level view, and then we'll dive into each component. So 1 being appreciation, 2 being cash flow, 3 being debt pay down, and 4 being tax benefits or depreciation. So I think that these returns are really imperative to understand when you analyze investment purchases. So let's go through, a more detailed understanding of each component. So appreciation, that is simply how much the property value increases over time. And according to Case-Shiller, real estate has appreciated at about 3% a year at a national level over a 100+ year time frame. So that doesn't mean every single year you're guaranteed 3% increase in asset value. Rather, it means on average, you can expect a 3% averaged appreciation rate on your asset. Assuming you, well, I guess if you own it for 100 years, but I think that can be extrapolated, to 30 years or 20 years, which means that some years you're going to see really, really good years, like 2020 through, half of last year. This year, we might not see any appreciation. We may see negative appreciation, meaning asset values declined, especially market specific in Colorado Springs and Pueblo. We're starting to see that from a year-over-year standpoint, from our monthly, sales data. So I think that is just really important to understand that on average, it's about 3% nationally. And then also something I wanted to point out here is that when you leverage a piece of real estate, you own the whole asset, even though you're only putting in, 20%. So say you purchase a home for $100,000 and you assume a 3% increase. So next year it's worth $103,000. Well, you get to own that extra $3,000 of appreciation, even though the bank has let you borrow 80% of the asset's value through leverage. So that's what I think is the most powerful piece of this, is just from that long-term perspective. So you figure, let's extrapolate that. How does that look like if you buy $1 million worth of real estate? That's going to add up quite a bit over, a few decades. So just keep that in mind. Then again, you can use that equity to buy additional real estate. So the second component is cash flow. And I think that's what most people think of when they first start investing in real estate. I know that's what I focused on as well until my eyes were kind of open to the other components. So cash flow is simply your rent minus your expenses minus your mortgage payments. So if you have a property that rents for $1,800 in rent, and then you have $500 in expenses, like say you had to fix a toilet and you had to pay for property management, and then you have a $750 mortgage payment, $550 of that is monthly cash flow before taxes. Of course, from that, you also need to budget for contingencies. And again, that's CapEx, maintenance, vacancy, that we already chatted about. So put a portion of that aside into a savings account. So when it happens, you have access to it. And the goal is to eventually be able to live off that cash flow. I think that's what most people's real estate goals are ultimately. And the third one being debt pay down. So this one is something that I personally didn't really consider until, fairly recently, is that when your tenant is paying your rent each month and you're paying your mortgage as a result, the principal reduction is, that's yours. So every time you pay down your mortgage payment, you're paying principal and interest, assuming you haven't have a regular conventional amortized loan. You don't have an interest only loan. And so when that tenant is paying your rent, they're paying a portion of your equity. So they're thinking, or they're actually paying your principal and interest, of course, which is just an expense to the bank for letting you borrow their money. And then the last one is tax benefits and depreciation. And I know that we've gone over this in some other podcasts quite a bit. So we don't need to go super in depth for this part, but depreciation is an accounting method in which to allocate the cost of an asset over a useful life. And the IRS defines, just a traditional buy and hold rental property as 27 and a half years, and then 39 years for non-residential real estate, short-term rentals. And then within that, various components have other schedules such as 5 and 15 years. Like think refrigerators, those are 5. 15 is like land improvements, fencing, that sort of thing. And just know that land itself is not depreciable. It's a non-cash, or another term for it is the phantom expense. You may have heard that. So meaning that you can have net cash flow positive properties, but results in a taxable loss thanks to depreciation. So that's a pretty phenomenal aspect to real estate as well. So, when you consider those four returns, I cannot think of any other investment vehicle that has the potential to earn a return in 4 different ways. And if anyone out there does know of a way to do that, please let us know, because that's very interesting. I would love to hear about it. But I think this is why real estate, in my opinion, is such a powerful investment vehicle, because of these components. And then lastly, I wanted to talk about some of the assumptions used in Southern Colorado property analysis. And please, please, please do not take this as, written in stone. These are very, very variant. But they're just rules of thumb. So, analyze a property. If you end up going under contract on that property, then you really need to do a deep dive, with your insurance agent, looking into the taxes, looking into your property management company, that sort of thing. And really kind of assess these components yourself. But just, rule of thumb, if you're going through and analyzing a property, these are sort of the, general guidelines that I would recommend, just for a cursory review. So for vacancy, 5%, you can adjust that based on market trends. I like to do 5%. That, pretty much means that someone's going to turn over once every 2 years or so, and it's going to take you about a month to, clean up the property and get it rented out. I think that's a very fair assumption, and that's also in line with some of the reported data that we've been seeing in this area. And then property management, I would account for 10%. That's pretty typical what we see property management firms charge. Repairs and reserves. So this is interesting. So sometimes, not always, sometimes the HOA will handle exterior items for condos and townhomes. So we kind of assume that if you're paying an HOA fee, that's kind of your way of paying towards the reserves of the exterior items for condos and townhomes, if the HOA covers it. So we're able to reduce, the reserves that you personally need to set aside. We usually use about 5%, and that's just based on feedback that we've gotten. And then, if you have a detached home or a multifamily home, 8 to 10%, I think is a good estimate there. 10% for sure, if or more, if you feel like that's necessary to use if the property's older or has more obvious deferred maintenance items. You're not always going to know that there is a deferred maintenance item. So like, even if you get a very thorough inspection, your water heater might just kick the bucket one day and you had no idea it was coming. So, just kind of keep that in mind, that you cannot possibly plan for everything specifically, but I think planning in general is very important. So then insurance. Oh my goodness. I have gotten slapped in the face with all of my insurances this year. They are definitely going up. We are seeing all of our clients' insurance costs going up. My understanding is just that, I guess, like the rebuild cost is pretty significant, just because we all know the cost of everything is going up. So I think that has a lot to do with it. And I don't really know the specifics necessarily, but I just know that your insurance probably will go up. So just be mindful of that if you are an existing landlord. if you're looking to purchase, this guidance is definitely a lot different than what we've been saying in past years. So again, condo, townhomes, common ranges that we see, please check with your insurance agent. Please make sure that you get the appropriate coverage. Like, don't cheap out on your insurance. That's like the one thing that you should not do. You should always just pay that extra couple $100, even $1,000 is worth the peace of mind. But generally speaking, for condos and townhomes, we're seeing about $800 to $1,500 a year. Detached homes, about $1,500 to $2,000 a year, and then multifamily homes. This is where I saw the biggest jump. Personally, I think I was at like 2,400 for one of my fourplexes, and now it's at 3,400, I think. So I'm expecting my other fourplex to get smacked the summer when that policy expires. So to renew that is going to be quite a bit. So just keep that in mind that we're seeing about 2,000 to 3,500 on duplexes through fourplexes. So keep that in mind. And then taxes. Get this figure from the MLS or public records. Make sure it's the most up-to-date assessment. Just remember, at least in Colorado Springs and Pueblo, properties get reassessed usually every 2 years. So they will go up. Just keep that in mind. But that was basically the first part of the Southern Colorado investment guide that I wanted to go over. And we will have 2 more modules in the near future. Again, wanted to keep this bite-sized, but please stay tuned for the next 2. Thanks, everyone.